Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And this morning I was just thinking about a scenario that I think that just about any veteran trader of options has encountered, and a question that they've asked themselves. When I'm about to place a trade, we might pause and think, what does the other trader here know that I don't? I'm about to enter into a contract. What is that other party thinking? Why are they willing to take the other side of the trade? Well, today I wanted to go through 5 ways that options buyers and options sellers think very differently. I think this is going to be a great discussion. I think there are going to be some good insights, particularly for those that are really just trying to get their feet wet with this world of options trading. But even if you're a veteran, I think there'll be something important for you to learn. So we're going to dive into this, but before we do, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see all the familiar names. Great to see anybody who is here that's new. But hello there, Lawrence and Ricebird, Emmanuel, Marcus, Eva, Jack, Rojo, Robert, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you happen to be among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. I always say that's a great way to watch these webcasts. But if you'd like to be here in our live stream audience, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. We'd love to have you here in the audience. Now, I also want to welcome my very good friend, Kevin Horner. He's going to be hanging out in the chats with us. He's going to be addressing any questions that I can't get to just during the natural flow of things. We've been working together now, Kevin, for years. So I think just about everybody knows Kevin. You know what great knowledge he brings to this discussion. So thanks for having my back, Kevin. Now, Kevin and I would also like to issue an invitation to everybody listening, whether live or on the archive, to follow us on social media. It's the place to connect with us in between the live streams. So you can find Kevin and me on X. You can also find and follow your favorite coaches on LinkedIn. So find us on X at Kevin Horner CS or at Cameron CS. And you can find me on LinkedIn. Just go to linkedin.com/n/Cameron May CS. But let's get to this discussion. And as we do, of course, there are risks associated with both sides of the coin here. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And any investment decision you make in your self-directed account is solely your responsibility. All right, so let's talk about what we're going to talk about. Set an agenda for today's discussion. We want to take a look at trading options through two different lenses, from the buyer's perspective and from the seller's perspective, and really try to understand what that other party may be thinking as we're considering getting into a contract. So we're going to set up an example trade scenario. So we're going to take, first of all, the position of a call buyer of a potential option on Apple. That's going to be our example trade today. But then we're going to look at that from the call seller's perspective and do kind of a bit of a back and forth between 5 different ways they may see that very differently. And finally, let's see if we can get in there and place an example trade before we're done. So let's go right to the Thinkorswim desktop trading software platform. This is the paper money version of the platform. And here's a chart of Apple. And let's just say, again, putting ourselves in the shoes of a would-be option buyer, let's just say they've looked at Apple and they've noticed that, boy, left to right, this has been a great year. This was a $200 stock 12 months ago. It's basically a $300 stock right now. For the bulls, it's been a great run. And recently, Apple has moved up really pretty explosively relative to other historical moves, but has pulled back down. And let's say that our trader here is fairly convinced that this old price ceiling from back here in, when was that, November? Looks like that's acting as a pretty good near-term support level. And maybe their outlook is for the stock to rise up from here as we're looking out toward July and beyond. Right? So that's our our chart premise. How might we put that into action using options? Well, let's go. I'm going to be using just a call option for today's example. There are so many other strategies we could discuss to use as a backdrop for this, comparing buying versus selling. It might be a single leg option. It might be a multi-leg option. But we're just going to look at things through the lens of buying a long call. So let's go to the trade tab. And, assuming, let's say that our trader thinks that it might take, I don't know, the rest of June and into the middle of July to get back up to these highs, that July contract might provide enough time, but let's say they go out a little bit further. Let's go out to the August contract. Make sure that we have adequate time if this trade plays out as the trader is expecting. So how about we use the 21st of August as our example here? And with the stock trading at about, I don't know, it's right around 300 bucks. I do know, I shouldn't say I don't know, it is trading right around 300 bucks. Let's say that we're looking at maybe buying that $300 call. So here are the terms of the contract. So we're going to buy, and this is just an example trade, buy the 21st of August, $300 call, and it looks like that's trading for between $12.50 and $12.80 per share. Let's say it's $12.65 per share. All right, so that's the potential contract, but let's say we're going to place the order. We're going to click on the ask price and start to place our trade, but then we hit the pause button. How many of you have done this before? About to place a trade and you just wait an extra moment and think, wait a minute, in order to get into this contract, there has to be somebody on the other side of the contract. So there's a seller involved here. What is that seller's motivation to get into this contract? Because I think the stock is going up. I think this call is going to appreciate in value. I think there's potential for reward here. But what am I missing that this other party may be thinking? And so we hit the pause. Well, let's do a comparison. Let's look at 5 reasons why an option buyer and an option seller may be looking at exactly the same trade and seeing it through entirely different lenses. And number 1 is just they have different goals for the trade. As a contract buyer, what's possibly the primary motivation for buying that option? Now, there are lots of other things that we could get into, protection, other things like that. But very commonly, the primary goal of an option buyer is value or price appreciation in that contract. They're trying to grow their account. So growth is the motivation, very commonly, of options buyers. Whether we're buying calls, we're hoping they grow in value, or we're buying puts, we're hoping they grow in value. So what we're doing here is we're spending $12.65 per share. That's $1,265 that's being invested in this theoretical position, plus a little hidden commission that we haven't, I won't really, unless we actually place a trade. That's when I'll go back and cover the particulars of a commission. But let's just leave commissions out of this discussion for just the moment, just to keep it a little, just one level simpler, all right? But we're spending $1,265 here. What are we hoping that $1,265 does? We hope it goes up in price. Now, if we are, let's look at what this call is accomplishing for the trader. If you're not familiar with a call option, it's a contract. We're entering into another contract with a seller of the contract where we're paying them for the right to buy 100 shares of stock. This is a standard contract representing the potential exchange of 100 shares. But we have the right to buy at any time up through the 21st of August, 100 shares of Apple in this case, for $300 per share. Now, in exchange for that right, we're spending $12.65, and that's going into the account of the seller. At least the majority of that. There can be a little slippage between the bid and the ask price, so they get the bulk of that $12.65. But here's what this buyer is hoping for. They're hoping for the stock price to go up and for their investment to appreciate. If we buy while the stock is down here close to 300 and that goes up to 315, maybe it goes to 320 or 330 or 340, we still have the right to buy the shares for 300. And there is tremendous upside potential in this trade. So for buyers, very commonly they're attracted to that potential. That's not necessarily what's attracting the seller. What is the motivation for the seller? Well, the seller's saying, hey, Cameron's willing to pony up $1,265 here. That's going to somebody, might as well be me. So the seller is actually motivated by income rather than price appreciation in their investment. So growth versus income are kind of the two differing motivations. Now, can both possibly be accomplished within the same trade? Just because an income was generated, does it mean that the call seller is out? Well, let's say if growth happens, if the stock goes up in price, does it necessarily mean that the seller is losing money? No, we don't know that. We don't know what this is part of. It might be a covered call. It might be a vertical spread for them, but the income is their motivation. It might still be realized even if the value of the contract appreciates. Somebody's saying, oh yeah, so they've done some covered calls in the past. Great. All right, and exploring new strategies. Very good. So you say you're exploring cash secured puts as well. Well, this series hopefully will be helpful in learning about those strategies. Anyway, but just be aware that there can be very different goals from the buyer to the seller. It doesn't mean that one is right or that the other one is wrong. They just have different, really driving motivations. Number two, and I always like to keep an eye on the chat. Thank you, Kevin. Classes like this really help to demystify the process. Yep. Anyway, but distinction number two between buyers and sellers, what their motivations might be. Buyers tend to be, not every buyer under every circumstance, they tend to be, they have higher risk tolerance, or they have a greater capacity for inconsistent, from one trade to the next, performance, as long as their portfolio is performing overall. It's kind of the difference. If you'll forgive me a baseball analogy. I know not everybody watches baseball, but are there baseball players in the Hall of Fame that didn't really get on base a lot, but they hit a whole bunch of home runs? Yep. Are there players in the Hall of Fame who were just really good at getting to first base, even though they didn't knock it out of the park all the time? Two very different types of players. Both may have very productive careers. So with options, it can be similar. Now, obviously, I can't guarantee career performance for anybody, but the motivation can be very different and the risk tolerance can be very different. So from trade to trade, maybe our call buyer has a greater tolerance for risk. There is a higher probability of a loss on a call that's purchased than on a call that's sold. Let me look at this. If I go to the trade tab, and let me just hide this order for just a moment. We go back up to the options chain. I'm going to go to the $300 strike that we're considering here. I want to talk about this number right here, delta. What is this number? Well, this is the probability. Well, there are two things that delta might tell us. Number one is this tells us how much the contract might make or lose on a $1 move in the stock. So that's one thing that it can tell us. Number two is it can tell us the probability not of success or failure, but that this contract retains any value at expiration. All right. So if we were to look at this as a percentage, we can see there's about a 54% chance, kind of a wash here. There's about a 54% chance that if we buy this contract and we let it go all the way to expiration, it still retains a penny's worth of value at expiration. That's what that number means. Now, we don't want to make a penny on a contract. So those are not strong odds. For the seller, what they're looking for is for that contract to just get as close to worthless as possible. And so they might look at this strike price and think, well, there's a 54% chance that it retains some value at expiration, about a 46% chance it has no value at expiration. They just keep that 1265. They may look at a different delta and see those probabilities change. But the risk tolerance here can certainly vary from buyer to seller. And there's a statement that I can make that carries on from one option to the next. It's very consistent. And that is when we buy a call or we buy a put, the probability of making money is less than the probability of losing money. Why is that the case? Whether we go in the money, or we go out of the money, whether we go for a 10-day contract or a 100-day contract, when buying an option, the probability of making money is lower than the probability of losing money. Why is that? Well, it's because of time decay, and it's because of the spread between the bid price and the ask price. A little bit of slippage is what we call that. So probability is not in the favor of the option buyer. What is in the favor of the option buyer? The growth potential. There is, when we buy a call option, unlimited growth potential. If the probability is not in the favor of the buyer, who is it in the favor of? It's in the favor of the seller. Yep. So in particular, sellers get their highest probabilities. You'll notice those probabilities of the contract retaining value at expiration decrease as we go up in price on these calls. So going out of the money of the options increases the probability of success. So for some, they may define risk as the probability of losing money. And so if that's the scale we're using, that might tilt things toward the seller. They have a lower probability of losing money. Now, does that mean that the seller has an absolute advantage in just risk overall? Nope. There's another thing that we need to consider if we're being balanced here. When we buy an option versus we sell an option, who has the greatest, let's say, worst case scenario, or the most impactful worst case scenario? Well, for the options buyer, the most that they can theoretically lose is just the investment that they've made. With an option seller, unless we're dealing with a covered position, like a covered call or a vertical spread, if we were to sell a call option, if it's a naked position, that can have unlimited risk potential. But just know, as we're weighing the pros and cons, an options buyer may have very different goals from an options seller, growth versus income, and the risk tolerances can be very different. Now notice, neither one of these is making a statement that one or the other is correct or incorrect in our scenario here, right? But let's go back to our trade tab and let's start to outline the third distinction. And that is, the stock outlook can simply be different. With our options, with our call buyer here, they're buying because they think the stock is likely to go up. It looks like. And I think some of you might be looking at, boy, Cameron, you've made a pretty convincing case. It looks like this old price ceiling has been a pretty good price floor. And even today, price is appreciating. And it doesn't look like there's any obvious price ceiling between where we are right now until maybe we get up to 318-ish bucks. Boy, that just looks like this has to work out, right? No. Nope. Let me look at this same chart through a very different lens. And maybe someone else noticed this as I made my initial drawings. Let me remove this drawing, and I'm going to remove this drawing. Maybe our call seller here, who is taking a bearish position by selling the call, they think this stock has just overextended itself. Maybe it's run up to the upside, and then it started to pull back. Notice how quickly the stock is falling. There is a phrase in trading that stocks tend to climb stairs and then jump out windows. And boy, over the last, well, this is about a week and a half to 2 weeks ago, Apple really took a pretty steep dive relative to its rate of ascent here, a very quick drop. And for some sellers, they might think, you know what, this is kind of a sucker bet. Maybe this is what we call a dead cat bounce. The stock has established a new direction. It's falling hard and maybe just bouncing a little bit before possibly encountering resistance let's say maybe they think it's not going to get above 300 bucks. Maybe they think that this new bearish momentum is just taking a short-term hiatus, and possibly they expect the price to go down. Now, who's right and who's wrong? We don't know. Nobody knows the future. Absolutely. You've never heard that one before, Eva? They climb stairs and jump out windows. Yeah, I think we've all sort of witnessed that. If we haven't heard the phrase before, we see, for example, while I was on vacation. So I've been out of the office for a month on a sabbatical, tripping around Scotland, had a great time. During that month, the markets worked their way up. The S&P was working its way up and up and up. And I was thinking, hey, this is pretty great, having a great month while I'm out, just not even having to attend to things. And over the course of about 3 weeks, the S&P worked its way to highs and gave it all back in about 2 days. That's very recent history, very representative of this sort of assumption that's commonly made by traders, that stocks will tend to climb stairs and jump out windows. And that's kind of what we've seen on Apple. And maybe this is establishing a new direction. So it's possible that our trader just has a very different stock outlook. Now, should that influence the decisions that we're making? Well, we don't even know that's the logic of the other trader. We don't want to probably expend too much emotional or let's just say, yeah, just energy trying to figure out what the other party's up to. So let's look at the fourth way that options buyers and options sellers might see things very differently. That is not just their stock outlook, but their outlook for the option. Matter of fact, yeah, I'll just say it that way. The option outlook. What do I mean by that? Well, our stock trader might think that options prices are going to go up. Our option buyer might think that the option price is going to go up. And an option seller might think the option price is going to go down. You think, well, Cameron, that's the same thing. It's just that we think stock price is going to go up or down. No, there's another variable at play here. And that is volatility levels can also influence the price of options. And our buyer and our seller might have very different views of volatility levels. So let me do this. I'm going to take the drawings off of here. Let me just clear this drawing set. And I'm going to add a tool that I think a lot of you have seen. Some of you maybe have not. But let me go at a little bit slower pace. So what I'm doing is going up here to the Studies flask, the Edit Studies icon. And we're going to add a technical study to our chart. It's known as implied volatility. It's an expectation, implied volatility expectations. Let's add that to our chart. Click Apply, click OK. And we're left with this green line. What is this? Well, for some, they see this as a general pricing of the options on Apple. So this is kind of what's going on with the stock price of Apple. This may be seen by some as what's happening with the options prices for Apple. And you might think, well, aren't they the same thing? No. Actually, sometimes we might look at a 30-day contract on Apple, and I'm just going to grab some numbers out of thin air here, but it might be, let's say, $5 for those 30 days. And at other times, we might be looking at a 30-day contract on Apple, and it's $7 or $4. Well, the volatility, the expectation of future moves on Apple actually has an impact on the pricing of Apple contracts. When traders of Apple contracts expect Apple to get more volatile in the future, if they think, boy, we're about to move, whether up or down, just about to move rapidly somewhere, buyers of contracts will tend to drive the prices up in anticipation of that. Just think about this. If we're looking forward the next 30 days and we think, ooh, something big's about to happen, maybe call buyers snatch up a bunch of calls, driving price of calls up. Maybe put buyers buy a bunch of puts, driving the price of puts up. Or we could have speculators that are looking for a big move. There may be hedgers there that are trying to hedge against a big move on their portfolio using options as that hedge. But in any case, as future expectations for volatility rise, the price of contracts on Apple typically rise. Well, what's been happening with our volatility level recently? It's been coming down. Now let's see. Olga, I did have an amazing vacation. Thank you. Matter of fact, so I had a great time, but now I'm home. I'm alone. My wife stayed behind. She had 3 friends that showed up, and they're gonna still trip around Scotland for 2 more weeks. So, yeah, we had a great time, and my wife's still there having a great time. That's fantastic. All right. But here's what our buyer might be thinking. Our call buyer might say, hey, look at this. When volatility was high, the pricing of options was probably pretty high. I can buy options right now at price levels that are lower than they were maybe at the end of March, the first part of April. They may look at this as a buying opportunity. Now, that's a buyer's perspective of things. Maybe they expect volatility level or volatility expectations to start to increase again. And if they do, that might drag those options prices upward. However, oops, let me do this. Let me remove that drawing. I know, Eva, poor Cameron. Yep. Nope, I'm good. Of course, I miss my wife, but I'm glad she's off having a great time with her friends. Now, the seller may have a very different look on this. They might say, hey, volatility levels are falling, and they might fall further. They certainly have in the past. So if those volatility levels continue to decrease, that can push prices even lower. So if they sold an option today and the prices go down tomorrow and next week, maybe they can buy out of that contract at a lower price and thereby realize a profit. So the option outlook can be different from buyer to seller. That's what this chart may represent. Now let me remove that drawing. And there's a final variable. Now, what I would like you to do as I outline this, I'm going to give what I see as 5 reasons why a buyer and a seller might see an option contract very differently, an option scenario very differently. Think about what I may have overlooked. This isn't intended to be an exhaustive list of the only reasons why buyers and sellers can see things differently, but I think it can still be very helpful. It can get us a long way down the road to understanding how people can have different perspectives on the same trading scenario. So the final thing here, little sing-songy, rhymey thing that I just came up with this morning. I'm fairly proud of it, so I hope you are as well. One, the buyer may be trading the stock. The seller may be trading the clock. So what do I mean by that? Well, our call buyer here they have a theory about where they think the stock is likely to go. And if the stock goes in that direction, if we buy a call and the stock goes up as we anticipate it might, that can be good for this contract. And really, the further it goes up, the better. So it's really, in many scenarios, the stock that's driving the performance of that long or that call contract that we purchased. So the buyer is commonly motivated by what the stock is doing, and they're looking for a big move on the stock. Now, working against them is time, because if the big move isn't materializing, but time is ticking by, we know that we have that time decay element in the contract, and that becomes the enemy of our call or our options buyer. All right. The seller may have precisely the opposite motivations. They're not trading the stock so much as trading the clock. They're trying to get time working in their favor, and they sort of are hoping that the stock doesn't move too much before we can hit expiration and realize the potential of that trade. So time is working against the buyer and potentially for the seller. Now, if the stock makes a big move, the buyer really likes that. That might not work out so well for the seller. Miral, you like that? Describe the seller versus the buyer, the clock versus the stock. There we go. Yeah, maybe I'll make that my thumbnail for this webcast. Rita's asking a different question. How do we know if it's a bear flag or not? Rita, I have a little bit of time. I don't mind addressing that. I do teach a webcast that's more about charting on Fridays. But I would say no, this does not look like a bear flag because it's typically, I think this is what you're looking at right here, sort of that upside down flagpole with a flag going up here. Looks like a bear flag, but a bear flag is a continuation pattern, which typically happens after the stock has already been moving down in a trend. This was actually moving up in a trend before the emergence of that. Otherwise, it might be a fairly textbook looking bear flag. All right, but let me just remove that. But guys, so let me do this. As we recap these 5 different ways that buyers see options very differently than sellers do we really need to spend that much energy trying to understand the other party now that we understand maybe, okay, things are just different for them? No, we don't have to try to get into the mind of the other party every time we're about to place a trade. Now, another thing is, I want to make 2 points. Number one is that nobody's obligated to just be a buyer or just be a seller. We may be a buyer on one contract and see a different set of scenarios on another trade on a different stock and choose to be the seller then. Sometimes our own preferences for probability, for time decay, for what we think is happening with the price of the stock, that can vary, or the price of the stock or the price of the option, that can vary from one position to the next. And so the same trader at the same moment may be a buyer here and a seller there. Another thing, maybe this will take some final pressure off our shoulders, is that sometimes there's not even a buyer on the opposite end of a selling contract, or a seller on the opposite end of a contract that we're buying. What do I mean by that? Doesn't there have to be a second party? Yes. Is that other party always someone with opposing motivations to what we have? No. Nope. Sometimes when we go to buy a contract, there's not actually someone looking to sell a contract at that moment. So who takes the contract, the other side of the contract? Who sells that contract to us? That could be, that in some scenarios is a something known as the market maker, an entity. I was trying to decide how to describe it. An entity is a good way to put it. But the market maker, their role is to make sure that when someone wants to buy an option, there's a seller there. When someone wants to sell an option, there's a buyer there. And if they can't find a matching party for that contract, they take that role. And it's not because they have different goals. It's not because the market maker has a stronger or lower risk tolerance, that they have a more bullish or bearish stock outlook, that they have an opposing view of what's happening with the option. It's not a stock versus the clock scenario. It's just that's their role. And they get compensated for that in the spread between the bid price and the ask price. But guys, how about we go ahead with a trade? Should we take the side of the buyer or the side of the seller? Well, how about we just continue as the buyer here? Let's just say that we are fairly convinced that the stock seems to be bouncing off support level. We think the stock is likely to go up. We see volatility is low. Maybe we see that as an opportunity. Prices, generally speaking, we can say that we're probably in the 10th percentile for the lowest prices we've seen for the last 12 months. Or in other words, about 90% of the time, our volatility levels have been higher over the last 12 months than they are right now. There you go. BSD Kid says market maker's role is to provide liquidity in the market for a tiny commission. Well, let's just say for compensation. Tiny can definitely be in the eye of the beholder, and sometimes the spread between the bid and the ask price can get very wide if that market maker particularly is struggling to pair up traders. In other words, if the contract is illiquid, it can force the market maker into higher risk scenarios, and they might require stronger compensation as a result. But let's go place our trade. Let's go to our trade tab. Right or wrong, maybe some of you might take the approach of being the seller in this scenario. I do at least want to just show how the trade might be placed. So on Thinkorswim, we go to the trade tab, we type in our symbol, we go to the option chain for the contract time frame that we were considering. We go to the strike price and then click on the ask price to place that buy order. Now, we already have a buy order queued up, but I'll go ahead and click on the ask price again. That'll bring that order back up. Ludos Labs says, can you also explore how much can it go down? What, you mean the stock or the contract value? Not sure quite what you mean there. And with my apologies, I probably won't have time to explore that today, but I do have a suggestion for you. If I didn't cover all the bases, and I didn't expect to today, I definitely have some resources for you to check out after we're done. But we're going to buy one Apple $300 call. Let's see if we can get it filled. I'm just going to leave it there at $13.20 per share at the moment. That'll be our limit order. As we click confirm and send, we know that a limit order is not guaranteed that we will fill. We're just saying we're putting a cap on how much we're willing to spend. So we're going to say we're willing to spend up to $13.20 per share. That gives us an invested amount of $1,320. That represents the maximum that we can theoretically lose, while this position has an infinite upside potential. You might say unlimited. There is a 65-cent commission on this position, but we're going to send that order off. There we go. All right, Ludos Labs, we got that trade placed. Let me pop right back here. How far can it go down? It can go to 0. But from a technical perspective, are there price levels where maybe there's some support? I think a trader might make a case. There's one touch point at that sort of 287 level. Some might say, Cameron, I think there's a stronger support level right down here where we get multiple touch points, maybe around 280. Is that a guarantee that's going to be the price floor? No. Could slip below that, could go down to 240, could go lower. Pardon me, voice decided that the webcast is over. Anyway, so yeah, let's wrap it up. Guys, we've accomplished everything I set out to do today. I wanted to outline 5 different ways, or 5 ways that an option buyer and an option seller see options just very differently. So hopefully that's given you some insight into the other party, whatever side of the trade we might be taking, what might be the motivations of the other person or entity involved in this transaction. But I'm going to let you go. As I do, though, I promise some additional resources, and this is a big one. I can't teach every concept related to options in 45 minutes, but we've covered a lot of those things in previous discussions, so make sure that you have access to those. First of all, if you're new to Schwab Education, welcome. It's great to have you. Make sure that you have subscribed to our Trader Talks channel on YouTube. You can go do that by going right down below, click on the subscribe button. It only takes a second to do that. It doesn't cost anything to subscribe to our YouTube channel. But the channel name is Trader Talks Schwab Coaching Webcasts. And this is where you can join these live streams. You can also find playlists. This is the big deal. Playlists of previous webcasts that we've already done. So for example, while I was out of the office for 4 weeks, Ben Watson stepped in for me and delivered some excellent webcasts. To find those, you go to playlists and scroll. We have a whole bunch of different webcast series, a whole bunch of different playlists. This one happens to be right down toward the bottom. So scroll on down to the bottom. There's Getting Started with Options. You can view the full playlist right there. Now, another suggestion that Kevin and I have for you is to follow your favorite Schwab presenters on social media. That's where you connect with us. Somebody says, how can I reach out to you? The way to connect with me in between the live streams is on social media. So you can find Kevin and me on X. You can also find your favorite Schwab presenters on LinkedIn. So you can find Kevin on X at Kevin Horner CS. You can find me on X at Cameron May CS. Just give me a follow here. And if you reply to one of my posts, like this video that I just forwarded of Barb, if you make a comment down here, I just try to reply right back to you. So that allows for communication when there's when the cameras aren't on. You can also do the same thing on LinkedIn. So you can pop over to LinkedIn. And if you reply to one of my posts here, I just try to reply right back to you as well. Actually, it's right here where you can see those comments. But make sure that you're following your favorite Schwab presenters out there on X and on LinkedIn. But guys, go have a great day. Thanks for giving me your time today. We're going to do this again next Tuesday. I will see you then. Kevin, thanks for helping out in the chat. Thanks for all the thumbs up. I see 172 people watching the live stream right now, and it looks like, how many? 53. Already clicked the like button. That's very, very much appreciated. That's like applause to your presenter, but it also gives me a nice boost in the YouTube algorithm, helps more people find my videos. So thanks for doing that. I will see you in a future webcast. I'll also look for you on X and on LinkedIn, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.